how business owners get money out of their business and pay less tax, part 2. So in part 1, we looked at dividends and distributions, so definitely check that out if you haven't. But in today's video, we're looking at salaries and wages and loans. So with the salaries and wage, so your business can pay you a salary and they will claim this as a deduction, and then you get assessed in your personal tax return. And with a salary as well, your company is obligated to pay your superannuation. Or you could pay yourself or get money out of your business via a loan. So you receive this principal amount tax-free, but then it has to comply with minimum loan terms. So it has to have a minimum interest rate, a minimum loan term, minimum repayment schedule for it to be considered a loan in the eyes of ATO, or else it will be deemed a dividend and assessed in your personal tax return. So in this example, getting 100K out of your business with a salary, you will have to pay superannuation. And therefore, in this example, the cash proceeds is 90K. And then you get assessed at your personal tax rate. And therefore, your after-tax proceeds is 47.7K in this example. So in part 1, we had the company and the trust where we were getting about 60K out of the business. So as you can see in this example, there's a lot less money that you can pull out of your company when you pay yourself a salary. And that's mainly due to this superannuation amount here. But one thing to also consider when you pay yourself a salary is that with this superannuation, it's not necessarily lost. It's not in your pocket, but it's reserved for your retirement effectively. And it sits there and only attracts superannuation at 15%. So if cash in your pocket isn't a main priority at this point in time, it's definitely a good option to consider about moving some of your money into superannuation, because you do pay tax at a very low tax rate compared to the company tax rate, compared to your personal tax rates. So if you're a high income earner, that might be a good strategy to reduce your overall tax liability and burden. And as well, if you're approaching retirement, that could also be a very good strategy for you as well.
And then just jumping on the loan, sorry, Dave, to jump in there. So with the loan requirements as well, under the Div 7A rules, the ATO is very strict in terms of the schedule and the repayment of that loan back into the company. So the ATO determines that the maximum loan term can be 7 years, and the interest rate that you need to charge, effectively the business charges you, is all set by the ATO. And you must adhere to the schedule, otherwise you breach the Div 7A rules, and then that loan then turns into a deemed dividend, and then you'll have to pay tax in your personal income tax return.
Yeah, definitely. In that example as well, with the 7 years, I believe if it's an unsecured loan, but if it is a secured loan, if it's asset backed, then the loan term could up to be 15 years. So in this example here, you could get provide yourself a loan, 100K, get that all tax-free, and use that cash to potentially buy an investment property, buy more assets, things like that. And therefore that will dictate the loan terms, and then also allow that interest to be deductible. So that's some other considerations when you have this loan. Obviously, there's more requirements. It's subject to these requirements by the ATO. You have to pay interest. You have to abide by this loan schedule. It can be quite tedious from that perspective, but it might be worth it from an investment point of view, from the ability to get cash in your pocket without having to pay any tax on it effectively. So some other considerations. So the opportunity costs of investing. Again, what's the cost of you having this cash in your pocket versus not in your pocket? When is timing important to you as well? So that also looks at the time value of money. cash in your pocket now. Perhaps you rather have that cash sitting in your offset account versus in the business account, for example. And then also entity structuring. So again, you didn't have to pay yourself through one avenue. You could split that across different avenues as well. And therefore there's more levers to pull, more areas to kind of control where your money sits and ultimately how much tax is paid. So yes, it can get quite complex, but it might be worth it overall if you're saving tens of thousands of dollars. So that's when it definitely helps to have a tax planning and strategy session. So if you are ever interested in a tax planning session, definitely reach out to FTC team. We would love to talk about it. So that concludes today's video. Have a good one.